Good morning, everybody. Welcome into Wealth Watch. Got a pretty interesting format this week, and we wanted to get right into it. We've had a couple of weeks of presenting concepts, and we wanted to put the control of what we cover today back to you, the webcast attendee. We've actually received a great deal of really good questions, and we want to use our time efficiently today, so we're going to jump right in without a lot of preamble. With me today, and all these people have been on previously, Tim Yessen and Bud Watson from our advisor side, and James Faraday, our CIO. We're going to go for 20-25 minutes answering questions. Hopefully we get through all of them. If we don't, we've certainly garnered enough interest around this format that we'll certainly do it again in pretty short order. But we're going to jump right into it this morning. And Tim, our first question, and I just received it probably 20 minutes ago. I really like this question. What do you do to try to avoid groupthink on the economic outlook, shutdown impact, political influence, et cetera?
Yeah, I think this is I really do like this question as well. Clint and I just got together on this to talk a bit about it. I think by nature, a lot of us are contrarians anyway. So when you look at our firm in general, we have average experience in this business of over 20 years for each employee. I've been doing this for 30 years now, and any of you that know me well know what a contrarian I am. And really, when you look at the data out there, the way our firm is designed, we are not siloed in the sense that we get our research from captive providers like most of the companies we've worked for in the past, and we think that's a real strength. When you look at how we receive our information and our research, we have providers that are independent providers of research, and we've got quite a few of them that we use for equity and bond research, and really for general economic research as well. And so having those varied non-captive firms that provide the research for us gives us, I think, a real clear advantage of not getting where we're all thinking the same thing. And I think it's a real clear distinction with some of the other firms. They tend to have they own the research companies that they use, and there can be this groupthink when it comes to economics, when it comes to the political environment, certainly. So getting various research providers to give us that information, and then we filter that through our investment committee, which I'll talk about in just a second, but our investment committee filters that information. And we all have, again, 20 plus years experience, different backgrounds and different strengths. And filtering that through there, I think, adds that layer of openness that we're after. What are we not seeing? What are we seeing? Are we seeing something that looks way too uniform that maybe doesn't end up happening? And really, the way we've structured the firm in general, I think this is the real key element. We're decentralized. We do not have a really strong hierarchy, which was intentional. It was designed to give every person a voice in here because we do have so much experience. And I think having that top-down approach that some firms have tends to weaken some of the voices down the line. We don't have that structure. We have a very open, non-hierarchical structure, particularly when it comes to investment matters.
Great. Does anybody want to add anything to that before we move on, or should we move on to the next question?
I would just add on there, Clint, that agree with Tim's comments there, and also just having a discipline that you can lean into helps you to kind of keep out some of the noise out there. So we've had a ton of noise coming through the media the last several months or last several years, right? But I think having that discipline and being able to lean into that during these types of times also helps to avoid the normal groupthink out there that might be coming through the media.
Great. Well, since we've got you pulled up on the screen, got a question here around investment philosophy, and really we've got two philosophy questions, so I'm going to put them together, James, and let you tackle these as you see fit.
Okay.
First question, are there permanent investing philosophy changes that take hold exiting COVID-19? And then as an underlying, not related questions, but something you may want to touch on as you discuss that, has this situation changed the philosophy and future confidence in REITs?
Yeah, two good ones there. I can definitely answer those in combination. So what I would say is this: the COVID has definitely not changed our philosophy in terms of how we approach things. Maybe just in some regards verified what we've been doing. Because if you look at our strategy and our approach, it is very much focused on quality in terms of balance sheets, cash flows. We look at earnings growth. We look at the consistency in earnings. So it really leads us to companies with those good balance sheets that have held up well in this type of environment, right? So I wouldn't say it's changed our philosophy. Now, I do think there are going to be some changes in terms of, which industries do well post-COVID. And we've already seen some of this delineation here in the last few months as the market has tried to figure out, okay, which companies are going to do well right in the current environment, and maybe which companies are not going to do as well. And certainly the ones that come to mind, right, the airlines, hotels, the tourism industry, energy companies out there. There's definitely a shift there, and there's going to be a different type of timeline around those specific companies. But I would say that the other factor here that I would mention, and there's been a lot of press around this, is technology has really come to the forefront. As a lot of us, you can see some of us at home today, and working out of our home offices. This has become very prevalent right across different industries. You've got a lot of tech companies already telling their staff that they're going to have the option to either stay at home or potentially work from home. So we do think that impacts the commercial real estate space, for example. So directly hitting that REIT question, that definitely has changed our opinion on commercial real estate. We don't necessarily think that commercial REITs go into a slump immediately. Most companies have long-term REITs out there, but that's definitely a change that we see coming out of COVID-19. More people working from home, companies realizing that in some respects they've had a more productive and a more efficient workforce working from home.
So how does that change our philosophy as it relates to REITs? What would the impact be in terms of how we would utilize that in a portfolio?
Sure. So we've typically held anywhere from about 2 to 4% in REITs in our portfolios over time. It's definitely forcing us to take a look at that strategic level of REIT exposure in our portfolios. So, for example, that is an area we're looking to trim back in, just because of some of those concerns longer term. I mean, we still think there is a place for REITs in portfolios. And keep in mind, REITs are not just commercial, right? You've got residential REITs, you've got hospital REITs, you've got different types of real estate out. You have the communication REITs, which have done really well in this type of environment. So it's definitely causing us to focus more in this sector and get a little more specific.
So I want to back up quickly because you mentioned airlines in the travel sector, and we actually did get a question just asking what companies don't make it through this. So I'd say that you could probably touch quickly on that, just given that you've already kind of gotten into that a little bit.
Yeah, so certainly those industries that I mentioned, they're gonna be under the most pressure, right? And I guess I would preface that my answer with, it is normal through a recession, it's normal through a bear market for companies to fail, right? I mean, I think that's the biggest thing that I would leave with our clients. That's a normal part of things. We definitely think there's more stress in those industries. However, the well-managed airline, the well-managed retail outfit, the well-managed energy company, those companies with the better balance sheet, more access to capital, more access to lending, we think come out the other end potentially even stronger as those industries kind of shrink and consolidate over the next couple of years. But that's where we've really avoided those sectors. Our discipline has caused us to avoid it going into this recession, but we've been very cautious with regards to those particular areas.
Okay.
But a lot of leverage. I mean, bottom line, companies with more leverage and weak balance sheets are going to be the top of the list for companies that fail.
Okay. How many crunches did you do on that exercise ball behind you this morning?
Just 5-10. That's my
probably already received 5 questions about that. Okay, so next question. Does the recent market drop have substantial effects on my estate plan? Bud, do you want to take that one?
Yeah, sure, Clint. It's a good question from the strategic planning side of our firm. These are things we think about and always appreciate opportunities to comment on them. Lower values is really sort of what the question is specifically asking about, and that can apply, and as James and Tim have mentioned, not only really to the stock market and your portfolio, but really to your whole balance sheet, real estate holdings, small business holdings, et cetera, all have had potential impacts on their valuations. If you think it's all going to come back and 2 years from now it's all like it was 3 months ago, probably your estate plan is totally fine. There'd be no reason to make dramatic changes. I think what it does offer, though, is if you do think there's a permanent change to a valuation, a business that, as James pointed out, perhaps isn't coming back, there's a few things that off the top of my head would occur to me. One would be you could transfer more as values are lower or depressed right now into trusts, et cetera, using the various estate transfer exemptions and gift tax exemptions and generation skipping tax exemptions. One of the things I think people don't think about that we just actually did for a client last week is looking at your estate and how it's being distributed. And we have a lot of circumstances where one heir may get the business, the family business, another heir may get some other asset. In this case, it was life insurance, and that seemed to be sort of equal. Well, this market downturn in the industry they were in raised the question as to whether the business value would recover to where it was before, and that made the potential for unequal distribution to heirs. So that's something I think worth running the math again on how your estate is being distributed. Other impacts, which probably each in itself is a separate topic, but just to cover quickly, we have not only a depressed market, but we have historic low IRS hurdle rates, which are under 1%. So some of the advanced transfer strategies, the most common one mentioned is GRATs, Grantor Retained Annuity Trusts, really have a combination of lower values of assets and historically low interest rates, which make those, if they ever were going to be appealing, they're appealing right now. So I think, like most of these concepts, I think if they didn't make sense before, they probably don't necessarily make sense now. But if you were kind of on the fence, or you looked at it and you were kind of convinced to do it, but not totally overwhelmed, it would really be worth revisiting some of these strategies. Roth conversions are one we think about a lot with lower market values. And then a simple idea, just like family loans, where we would have family members making loans to other family members. Those rates can now be at around 1%. So if there's any outstanding family loans, those can be refinanced. One quick thing I want to mention is I know a lot of concern. I want to make sure folks understand that concerns about engaging in estate planning because you may have to go meet with an attorney and that might turn some people off. I want everyone to be aware that incredible strides have been made, and particularly in Kentucky. Kentucky's been a leader in a lot of this, in remote signatures, remote notaries. So a lot of the, if not all of the estate planning right now can be done without human contact. So don't let that get in your way of revisiting this.
So, Bud, in terms of just revisiting the question, if the determination of whether or not it's had substantial effects is is a one-off. It's each individual and their estate plan and a determination at this point in time, it sounds like.
Yeah, and of course that's true of a lot of tax strategies. I don't think there's any compelling change that says I must change my estate plan, but I do believe there are there are details of individual estate plans that can be affected, or strategies that could be available that maybe hadn't been thought through before. One specific, though, to your question there, Clint, that reminds me of is living wills. I think everyone needs to look at, and all of your advanced medical directives. And the reason I say that is that a lot of us historically had phraseology about ventilators and respirators that we didn't think we thought of in terms of end of life, and we might have decided, I don't want that. Well, perhaps we do want that in particular related to COVID-19, that maybe a ventilator treatment is something that we would actually prefer to have, but our advanced directive says no ventilator. So you would be in a position where your family would not be able to get a ventilator approved for you, even though maybe for this treatment you might want that. So I think it's really worth everyone looking at their HIPAA-related provisions and thinking through them with their attorney.
Thanks, Bud.
Yes, sir.
So next question up. What are the 3 leading indicators that in conjunction with each other would cause you the most concern if they started trending the wrong way? James, that one seems appropriate to you.
Sure. Yeah, I can attempt that one. So one of the primary leading indicators we look at is honestly the stock market. Gives us a lot of clues on the future. And I think I've mentioned this a few times on Wealth Watch, but if you look at stock markets, typically bottom about 3 to 6 months before economic data, right? So if March 23rd is the bottom and of this bear market, we would anticipate the data to bottom out, right? The economic data anyway, somewhere, June, July, August type time frame is what we would think. But so the stock market certainly is one of those indicators. The PMI, the Purchasing Managers Index, is another one that we track pretty closely. So we saw the that index. It captures a lot of the economic trends. It's looking at new orders for manufacturing, production, employment, supply, delivery. So it's trying to capture a lot of different information. And the survey is directly speaking with CFOs and production managers. So it's really capturing a lot of good data there. So that's one we track pretty closely. So it bottomed out like a lot of well, I shouldn't say it bottomed out. But, it took a huge hit, went from over 50. When you look at that particular index, over 50 is an expanding economy. Below 50 is a economy that's contracting or growing at least at a slower rate. So we went from 50 something down to 36 in a hurry. The latest data has shown some small improvements over that base. So that's one that I would highlight. And then looking at the housing market is also a great leading economic indicator. Looking at the new building permits that are coming out. So I would say those are the ones that kind of come to mind initially that we would be concerned about if we saw a trend to the downside.
Thanks, James. Really quickly, we've got a question here. Are index strategies favorable as the market moves up from the bottom? And James and I spent some time 2 weeks ago, long form discussing that. I would say just by their nature, yes, as the market moves up, they show themselves as being more favorable. I'd say from WealthSouth's point of view, we're always going to want to engage some of those strategies within our portfolios. James, you can probably certainly add to that, but I would say sure. Our approach to using index funds in our portfolio doesn't change dramatically whether the market's moving up or moving down. Yeah,
we went into some depth a couple of weeks ago on another one of these programs if you want to get a real sort of more description around it. But active and passive tend to go in cycles. We incorporate both into our portfolios. Definitely in a bear market recession, active managers tend to outperform the passive strategies out there, the index strategies out there. Right, coming out of recessions, typically initially, active still outperforms passive until a bull market really takes hold. So, for example, in this situation right now, active managers have the ability to avoid the airlines, to avoid certain energy companies, to avoid certain retail and restaurant sectors out there, whereas index funds have to hold all of those in there. So initially active funds, but then passive funds, when a bull market really takes hold and correlations start to come together, that's where the index funds tend to do better. So bottom line, we think having access to both, and there's a lot of different, we went through the different criteria, different asset classes, different asset categories where it may make more sense to use passive strategies. But we think the combination of both through market cycles gives a more consistent return stream over time.
Thanks, James. So next question, I'm retired. Does the early part of the year affect my cash flow plans moving forward? Tim, are you still out there?
I'm here. Can you hear me okay?
I can hear you fine. I seem to have lost your video. So I'm assuming that, not unlike the estate planning question, this is user specific or client specific. But do you want to touch on our approach to answering that question when it comes to cash flow as a retiree?
Absolutely. If you've been through the planning process, again, like Clint prefaced this, each person's circumstances are individual, and we really tailor that withdrawal plan during retirement for that individual. But if you've been through the planning process, it's important to note that we have built in a pullback like this into the scenarios. We've stress tested your withdrawals to make sure that you can weather the storm through a process or a downturn like this. So the short answer is, if you've been through the planning process, it's incorporated into your plan, and we account for this type of pullback. Now, we didn't think it would be this compressed, but certainly a 20-25% pullback is incorporated into that plan. So you should be able to continue to do the withdrawals as normal. Now, during this period of time, you might be taking out principal, but as the market recovers and through the years, we know statistically that you'll recover from this, and the principal that you took out will be offset by some of the gains that you would get later on in the market. So we're going to get there with variability. Sometimes you end up in a market like this where some principal reduction happens in your portfolio for your retirement, but we know that you're going to be adding to your portfolio with the growth in those assets going forward.
Thanks, Tim. Sorry about the technical difficulties there. So I hope everybody enjoyed me looking on inquisitively as Tim answered that question. We're running up on time here, and I did want to get to a question from 2 weeks ago. It came up in our live feed Q&A, and I didn't see it until after we had closed out the call. But I'm going to read this question, and I'd like to get each one of you, if you wouldn't mind, to just give us a brief answer from your perspective as we close things out today. Since the first of the year, given all the variables in play, different agendas, and politicians with conflicting objectives, what is the most important lesson you have learned? And Bud, if you don't mind to kick us off answering that.
Sorry, I've learned that no matter how old you are, you still have something to learn, right? I do think that what is relearned, at least for me, is the value of being focused and attentive to your reaction to risk. And I think we've felt over the 11-year bull market a little bit of a slide, both with clients and probably a lot of advisors, sort of a laissez-faire approach to risk, that the market's been doing so well for so long that we've tended, I think, to more and more have a hard time convincing folks of the significance of your reaction to market downturns. So even though we preach it constantly and build it into all of our strategies, I think it now gives everyone an opportunity to be able to say, yeah, this is how I felt these last 6 months. And that's really valuable to a planner looking forward.
Awesome. Thanks, bud. James?
Yeah, I mean, definitely a lot of lessons, and I try to look back at the different recessions that we've gone through, whether through the tech crash, whether it was 08, 09, and what I've heard through all three, including this time with COVID, has been this time is different. And what I would say is, no, I don't think this time has been different. And at the most difficult time of the market, in that March period where the markets were going down, there was hysteria coming out of different parts of the country, different parts of the world. And there was even a lot of doom and gloom around our own office, right? That March period. And but at those moments, reflecting on the last 2 months, I would say I've learned that you have to stay true to your discipline, even in the most difficult times. And it was true in 2000, 2001, 08, 09, and then again this time. Not to say we're not going to have some more, market fluctuations here over the next couple of months. But if you're able to stay true to that discipline, lean into that during the more difficult times, I think that's the biggest lesson that I've learned on repeat. And you start to question yourself in the most difficult times. I think your mind starts playing tricks on you. So,
yeah, for those not in our office, there were a couple of days I became genuinely worried about James' countenance early to mid March. So Tim, we won't have you on the screen, but same question. What have you learned through all this?
Yeah, those of you who know me, I think you probably heard me say this before, but there's an economist from George Mason University that's a friend of mine, and he talked about how our economic system, he said he used to think of our economic system as a delicate flower that needed to be nurtured. But he said, no, Tim, as I've gotten older, I recognize that it's like a weed. It'll find places to grow through the cracks in pavement and a way to flourish, even in the most dire circumstances. What I've seen, and I guess the lesson is that people will find a way, that there's a resiliency in our economy and in our people and our system, how it's set up. And we've seen some of that. I've seen over and over stories about companies pivoting and making a change in what they do and how they do things, and it's been refreshing to see that. And I think that's something to carry forward with us, give us a little bit of inspiration. Some of those companies out there doing things that they wouldn't have dreamed of doing 4 or 5 years ago.
Well, guys, thank you for taking the time this morning. A lot of thoughtful answers. More importantly, thank you to those watching or those who will watch later on YouTube for taking the time to send us questions. We did not get to all of them today, so we'll certainly put this on the schedule somewhere down the line. Try to capture the ones we didn't get to, and certainly try to take in more of your questions at that time. I'm sure dynamics have changed, and we'll have a whole new set of questions to try to answer. So we will be back with you on June 10th for Wealth Watch. We're going to be talking about the CARES Act again, but this time we're going to be talking about the impact that it's had for 401k plans, both for plan sponsors and participants. So if you're a participant in a 401k plan, or somebody who's a plan sponsor who has some questions or would just like a refresher, this will be a good opportunity to have that covered. So until then, as always, we hope everybody stays safe, and we look forward to seeing you next time. Thanks a lot.